Hey everyone, this is Kirk here again at Option Alpha, and in this video we're going to talk about technical analysis, indicators, and signals. I think it's going to be a good talk today because we're going to get a little bit into the different types of technical analysis indicators that are out there, and then also talk about what really works and what doesn't. So first of all, we want to just kind of define what technical analysis is for those of you who don't know or are new, but it's basically just a methodology for forecasting the direction of prices through the study of past market data, primarily price and volume. Over time, it's definitely been increasingly popular because of its easy and visual nature of the indicators, meaning you can see the indicators on the screen. There's nothing abstract about it. There's nothing kind of out there. You can visually see if something is a buy or a sell. But this also falsely leads to the assumption that the markets are predictable. And I personally think this is one of the biggest points that I want to make in this video, is that the visual nature and the easy to read nature of technical analysis does not mean that it is predictable in determining the outcome of the direction of a stock. And I know that a lot of people fall into this pitfall early on in their trading career, is that they see the technical analysis indicators and it makes sense to them on a logical basis. So then they assume that because it makes sense and because they can see it, that it therefore is predictable, or you can basically make assumptions off of it or trade even profitably off of some of these indicators. And I'm here to tell you that that's just not the case. So there's a couple different types of technical analysis indicators out there, or methodologies. There's first, like your general support and resistance. So the stock goes up, it hits an area of resistance, comes back down, hits an area of support, etc., etc., etc. Then you've also got candlestick patterns. These are patterns relating to the open and close of the price movement in the day relative to the high and low. And again, it's not the actual candlesticks themselves, but it's the patterns that evolve through these candlesticks. So, a 3-day or 4-day pattern might tell you something about, what the stock might do in the future. And then we have chart patterns, which are really, really popular. Things like head and shoulders patterns, pennants, flags, all these different things, cup and handles. I mean, you probably heard them if you've been involved in trading, but all of these different patterns that are out there that you can basically, build and write and draw on with all of your charts. Now, in my honest opinion, a lot of these are subjective in nature. What might look like a head and shoulders top to you might also look like an uptrending pennant to another person. And you can't argue with that. With regard to candlesticks, chart patterns, support and resistance, it is all subjective, meaning it's what you see out of the charts, not necessarily what may or may not be there. Now, since I'm generally more of a math and numbers trader based on probabilities and statistics, I prefer to use indicators that give clear buy and sell signals on the charts. And that's just how I'm wired. So obviously, I want to go through some of these examples here so we can kind of start to lay the foundation in this video for how we can kind of use signals that are less subjective than, say, chart patterns or candlesticks, things like that. So first thing that we're going to do is we're going to look at a chart of SPY. Now, this is the SPY at the time that we're doing this video. This is actually the last 2 years on a daily basis. And what I've done here is I've overlaid just a simple 15-day moving average. This is that green line that you see here. Now, moving average is actually one of the more popular indicators that you kind of get started with, especially if you're new in trading. And the whole methodology here is that whenever the stock crosses above the moving average, then you want to buy it. And whenever the stock crosses below the moving average, you want to sell out of your long position or go short, or whatever the case is. Now, obviously, every indicator is going to work in some scenario, and other times it's not going to work. But this is, again, a very simple explanation or example of how an indicator gives clear buy and sell signals. Again, this is some of the stuff that I prefer, is to use indicators, not necessarily simple moving average, just to be clear, on that give indicators that are clear buy and sell signals. I know that the stock crosses below it, so that's my buy signal or my sell signal, whatever the case is, okay? There's also a bunch of other different types of indicators that you can add out there. So like, for example, you can add another popular one is stochastics. And so we can add, let's say, full stochastics to our chart here. And so with full stochastics, what you're looking for, in this case, you don't see any moving average up there, but what you're looking for in stochastics are these overbought and oversold zones. So basically you hear the terms, or probably will hear the terms if you trade long enough, a stock is relatively oversold or relatively overbought. But basically, whenever the stock gets up into one of these zones where it's overbought here or if it's oversold here, that those end up being the buy and sell points on the chart. And again, it just kind of correlates and gives very clear signals based on whatever you've set up as to where you should buy or sell. Now, there's a bunch of different variations in here too, and I just want to kind of go through some of these so you guys can see. We've also got things like Bollinger Bands. These are really becoming more popular. Again, very clear buy and sell signals with Bollinger Bands. You're basically looking at buying and selling the breakout of every single move. So when the stock breaks out of the lower boundary, and then if the stock ever breaks out of a higher boundary, then it didn't here. But if it did, if the stock ran up and broke out of this higher boundary, that would be your sell signal. So there's all types of different indicators out there. And again, most of this technical universe here is based on price, movement, volume, acceleration, things like that. Some other ones that are out there are MFI, which is money flow. This is another one that's very, very popular or becoming more popular. And you can see money flow has even clearer signals than some of the things like Bollinger Bands or stochastics. It's just one line, and it basically then again shows you kind of like an oversold range. So whenever the stock indicator MFI gets here, then you basically want to sell stock. So you would sell stock or go short here, or sell stock or go short here, and you might buy at these lower regions, which is buying here, etc., etc., etc. Okay, so there's a bunch of different ways that you can do it. There's literally thousands of different technical indicators out there that you can use, and I think the key is that if you are going to focus on anything, just first focus on the indicators that give clear, like mathematical reasons why there's buy and sell. So I don't prefer to use anything that's really subjective in nature, meaning that, it's a trend line that I'm drawing on the chart. How do you know that this, and this is a great example of this, but how do you know that this is supposed to be the support and resistance line versus, is this the support and resistance line? Or is this the support and resistance line? Or is this the support and resistance line? I mean, all of those things could be valid support and resistance lines, but they're all subjective to me. They don't really give us any clear indication of, why something might move higher or move lower, create a buy or a sell signal. So here's the deal. The real question becomes, which indicators really work? Which ones are actually reliable enough long-term to trade? So the question you might have is, should I be trading using the SMAs, which are simple moving averages, or stochastics, or MACD, or RSI, or all the other different indicators that are out there? Which ones actually generate a profitable trade that outperform the market? So even if you did find XYZ indicator that works, meaning that it is reliable to trade, it has good signals that work more often than it doesn't, does it actually generate profits? So when it works, do the profits overshadow the potential losses when it doesn't work? And I think that's a real key question that not enough people actually ask in this industry. So here's the deal. Back in 2014, we purchased our own in-house data and developed an in-house program to backtest technical analysis indicators. Once we had everything in place, we started backtesting hundreds of stocks and indicator variations, covering the last 20 years of market data. After 12 months of nonstop backtesting and analysis, we packaged everything up that we discovered and put it into a single comprehensive report. Now here's the deal. We are selling this report called Signals on our website. It is one of the ways that we generate money here at Option Alpha, even though we give away 99% of the things that we do, because this is something that I think is game changing. And I think it's something that everyone should have, but not everyone needs to have, or really we don't want to give it away for free because it's so freaking good. But we basically did 20 years of data, 223 different stocks, 17 different technical indicators. So we're talking about things like MACD, stochastics, Bollinger Bands, money flow indexes, volume oscillators, everything in there. 17 different indicators, 1,476 different variations. And what I mean by this is we tested the granular difference between buying at a 6-day moving average versus buying at a 7-day moving average and an 8-day moving average. Like, what's better? Do I use a 6, a 7, or an 8-day moving average? And 1,400 different variations between all of these different indicators. So the groundwork has been laid. We basically tested the living daylights out of technical analysis to see what really works. At the end of it, we ended up tracking about 17.34 million trades over the course of our year-plus study with all these different indicators and stocks. And basically, we were looking for 3 questions to be answered. Number 1, is technical analysis more reliable than randomly picking a stock's direction? Honestly, nobody has asked this question in the entire world. If all this stuff is so good, How good is it? Is it more reliable than randomly picking a stock's direction? That's number one. Number two, if it is, can you generate an excess return above just holding the market? Now, the question always becomes, is the market more efficient than any of these technical analysis indicators? And we want to figure it out. So one, if it was more reliable than randomly picking a direction, can you generate money above the S&P 500? And if you can, what are the specific indicators and settings that work best long term? So again, it was the difference between finding out, does the 6-day moving average as an indicator work better than the 10 or the 50 or the 100? Or does the 21-day RSI work better than the 18 or the 15 or the 13-day RSI? What are the settings that worked best long term? Now, of course, I'm not going to show you all the results in this video today because you do have to purchase a copy of the report to see what works. But there are 4 things I wanted to quickly reveal to you that we learned from the report, which will help you with technical analysis regardless of if you purchase or not. And that's what I wanted to get across here in today's video, because I think just knowing these 4 key aspects will dramatically help your success rate. Again, whether you choose to buy a report or not, you do not have to. We're not forcing you to buy it. It's not required to be successful trading options. It's for the people who want to know what indicators work and what don't. But if you know these 4 things, I think it will help you get a better understanding of the relationship between profitability maybe and technical analysis. The 4 key numbers that we're going to go over here are the following. One is that exactly 39 or about 5% of the 766 different long indicator variations that we backtested beat the S&P 500 benchmark net return. This means that 95% of the technical analysis indicators that we tested underperformed the market. Now, this is incredibly important because what this really means is that 95% of the indicators that are out there are basically junk and garbage and don't really work. Okay, so your goal is obviously to backtest by yourself, buy the report from us if you want to do that, but basically find the ones that do really work. And if you can't find them, you might even be better off just not using any technical analysis at all. And that's just the reality. The average win rate of all technical indicators tested long and short was just above 45%. So what this means is that as a group, flipping a coin would have been more consistent for a strategy of buy and sell signals. Now this gets back down to what I was talking about before. You do not have to purchase this report. Just with these 2 numbers, you realize that you actually have a higher probability of success overall. We're not talking specific indicators. We're talking overall. You've got a higher probability of success if you flip a stinking coin and buy or sell the stock based on the heads or tails of that coin flip. Because as a group, everything that we tested, so many different indicators, so many different variations, as a group, they were very, very inconsistent with just being able to pick direction. Now, obviously, some indicators were definitely better. Some indicators were definitely worse. As a group, they were so-so to less than profitable with a coin flip. 208 test variations blew up the model portfolio entirely. This is about 27% of the variations that we tested. That means that they created losses of more than 100% after commissions. And notably, short-term or day trading timelines under 30 days were not profitable. I mean, this one to me is the big one because we can basically put a fork in the ability for somebody to consistently, on a long-term basis, we're talking 20-year basis here, profitably predict where the market's going to go on a day trading timeline. Now you can go, again, you don't have to buy this report now. Now you can go out, figure out if it works for you or not, try day trading, come back after a year after you've lost money, tell us that we were right, that it doesn't work. If you've already day traded, you know it doesn't work. But now we've proved with numbers and statistics that it doesn't work under a 30-day timeline. Even really, okay, just a little hint here, even 30 days plus really doesn't work. And so we'll get into that a little bit more deeper in the report. But the reality is that some of these indicators were actually so bad that almost a third of them actually blew up the portfolio. So that's cause for concern. Again, you don't have to buy the report to know this. Now you know you should probably stay away from some of the indicators that might blow up your report or blow up your account. Now, the last thing is that transaction costs as an overall percentage of gains losses accounted for approximately 7%. So generally speaking, transaction costs were not a major drag on overall profitability. And what this really means for me is that there is no link directly between people who trade more and necessarily are going to lose because they trade too much, okay? There was no direct link that we found between over trading and profitability. So if you traded a lot, you could still make a lot of money. If you traded a little, you could still make a lot of money. So this idea that sometimes you can overtrade and trade too much, I think is not true. I think you can reduce risk by trading smaller, more frequent sizes. And again, we tested everything in our report from like a 1% allocation per trade to a 2%, a 5%, a 25% allocation per trade. We tested everything to see what really worked as far as allocation as well. And again, what we found is that the transaction costs and the churning of the account really didn't have a drag on profitability. What mattered more so than transaction costs, broker fees, all that stuff was actually were you using the right indicators or not. And that's what was really key. So here's the point. The right technical analysis indicators can help you make more profitable trades. The top 5 indicators we found generated winning trades 82% of the time and outperformed the market by 2,602% on average. And again, that's after combing through 17.34 million trades to see what actually works. But when it comes to options trading, selling options based on high probability strategies with defined risk always outperformed even the best technical analysis indicators. So once again, if I haven't said it a million freaking times in this video, if you want to buy a copy of Signals, we would be more than glad to sell it to you. I think it's an incredible piece of research and we've gotten a ton of amazing feedback from it. But if you are going to be successful in this business, you don't need technical analysis to be successful. It can help, but it is not required. So again, technical analysis can be a supporting factor in your decision to go long or short a stock directionally, but it should never be the only factor. So hopefully you guys enjoyed this video. It probably was a little different than you might have expected heading into it, and that's okay. I want to know what your comments and your feedback are. If you have questions about different indicators or about anything that we covered in the report, please let me know. If you love this video, please share it online. Help spread the word about what we're trying to do here at Option Alpha.
My name is Andre Algauer. I'm the Client Service Manager here at Trading Central. And firstly, I would like to welcome and thank you all for joining us for this webinar on building a trading strategy with the help of technical analysis advanced. Today's webinar is brought to you by Trading Central and Maze's Investment Company. Just to give you a brief background, Trading Central is a leading investment research provider to financial markets professionals with a 30-year track record, founded and run by experienced traders and analysts, certified performance and award-winning models, like you can see on this slide with me. Trading Central, award-winning investment research provider, founded in 1999 with offices in Paris, London, New York, and Hong Kong. Registered investment advisor with the U.S. Securities Exchange Commission, SEC, the SFC, and AMF compliant. Certified member of the Investor Side Research Association, promoting independent opinion free of banking conflict of interest. Our clients include over 100 investment banks, asset managers, brokers, in over 35 countries. Clients include Barclays, UBS, Deutsche Bank, Morgan Stanley, New Edge, and BlackRock. Today's webinar will be presented by our analyst, Cyril Berkut, who is a senior technical analyst at Trading Central. He covers all asset classes, intermarket analysis for U.S. and Latin America institutional buy-side clients. In regards to his education, Cyril received his master's degree on finance from the IGR IAE Institut de Gestion de Rennes. He is qualified as MSTA, Society of Technical Analysts member, and his experience prior to joining Trading Central, Cyril served as a technical analyst at Societe Generale, CIB, portfolio manager at KN Private Banking, and equity analyst at AXA Investment Managers. Cyril provides chartist and mathematical approaches from intraday trading to swing trading and long-term investment from institutional and private banks. He's regularly quoted in Bloomberg articles. So now I'd like to pass the word to our analyst Cyril Bickut, who will start his presentation. Thanks.
Hello everyone. So let's start with our presentation. Okay, just a quick word about Trading Central methodology. Trading Central combines complementary approaches to assess directional moves and price targets. We have a chartist approach, which refers to the analysis of technical patterns and volumes. A lot of mathematical indicators exist in technical analysis. They are used to give an indication of the strength of a trend. They are also used to indicate changes in trend and reversal trend signals. Only a part of them are used in the work of the analyst at Trading Central, like Bollinger Bands, Fibonacci numbers, MACD, RSIs, stochastics, volumes and moving averages. We think it's necessary to combine the information provided by technical analysis to form an opinion, and especially because our chartists and mathematical approaches match requirements of various investment styles, from intraday trading to long-term investments. So this is a quick presentation of the Trading Central methodology. So now we are focused on how to build trading strategy with the help of technical analysis, and let's start with key elements for successful trading strategy. The main focus is which question you have to ask you before defining a trading strategy. The most important questions is, of course, on the asset I want to trade. Is it bullish or bearish? It's the first question and the most important, of course. Technical analysis gives the answer by adding bullish and bearish arguments. So if you have more bullish than bearish arguments, your analysis should be bullish. For example, if you have a rising trend on an asset plus moving averages, with rising moving averages and a MACD positively oriented, you have several bullish arguments to say that your analysis is bullish. And conversely, if you have more bearish than bullish argument, your analysis should be bearish. For example, if you have a declining trend line with declining moving averages and a bearish trend line on the daily RSI, I would say your analysis should be bearish because you have a lot of bearish developments. So this is the key elements for a successful strategy. The first one, for sure, is it bullish or bearish? But the second very important question you have to ask you is about money management. The question is, what is set my pivot point, my stop loss, and considering this pivot point, have I an interesting reward-risk ratio? So actually, this question refers to money management rules, which are essential for every traders and investors who want to survive in financial markets. So regarding money management, so as I said, money management is essential for every traders and investors who want to survive in financial markets. Of course, losses need to be limited if your outlook proves to be wrong, because you cannot have 100% of winner trade. So your potential loss when you define your trading strategy must be limited. So is it a second rule I have to give you? The third rule is a reward-risk ratio is a crucial step when you define your trading strategy, because it determines if your trade idea is interesting or not. So it's very easy to understand the choice of stop loss, of the choice of your pivot point, allow to handle your reward-risk ratio. So your stop loss, your pivot point, has to be a key technical level. So I'm talking about pivot point, so I need to define what is a pivot point at Trading Central. So I think you noted I use the term pivot point when I talk about stop loss. Actually, you should use your pivot point for your stop loss, because a pivot point is a key technical level where we would turn bullish from bearish or bearish from bullish. So when you choose a relevant pivot point for your stop loss, you should have no regret if your position is top out. So you can see on several websites several mathematical formulas to calculate a pivot point. And there is no one way for calculating pivot points. But for us at Trading Central, I want to insist on that. A key pivot point is a key technical level. So we favor the use of Fibonacci levels, along with classical technical levels like gaps, the previous low or previous high, or trend lines, or horizontal support, or horizontal resistance. So if you had several arguments on a specific point, specific level, like a key retracement, a key Fibonacci retracement, plus, for example, a moving average, plus a rising trend line, you have a key level, a key pivot point, and you will be able to define an interesting trading strategy. So I insist on the fact that the pivot point should be the most important level, as it should be your stop loss when you define your trading plan. So I've chosen an example on a Russell 2000. So on the Russell 2000, but I have a daily chart. We have a daily chart that shows a daily chart on the Russell 2000, but the time frame and the asset don't matter in this example. You can apply this example for an intraday chart, for a weekly chart, for stock and currency pair. So the time frame is not important. You can do the same on an intraday chart on the euro dollar, for example. So let's start with this example. We are on October 9th. You can see that despite the consolidation, the index is still supported by a key rising trend line drawn from November 2012. And at the same time, the daily RSI is approaching a support. So we have several bullish arguments to say that the outlook is bullish, and despite the consolidation we can see just there, the outlook is still bullish. So the traders, the investor, should look for to enter a long position on the Russell 2000. In this example, a key pivot point can be set at 1036. In this example, 1036 is a 61.8 Fibonacci retracement plus a key rising trend line, the key rising trend line I mentioned, which is run from the bottom of November 2012. So we have two arguments to say that 1036 is a key pivot point and should be a key stop loss. But now it's not sufficient to say yes, it's bullish and I want to buy the index. I have to determine if the reward-risk ratio is interesting. So in this example, the current price is at 1043, and a first target can be set at 1088. Actually, 1088 is the previous high on the index. So if it's a previous high, should be a resistance. And a second target at 1130. The 1130, this example, is a full projection. Is a full projection of this up move, projected from the bottom at 1007. Okay, so the theoretical target on this example should be 1130. So with considering these elements, the reward-risk ratio is interesting, it's good at current price at 1043. As the risk is 7 points loss, as the stop loss is at 1036, and the potential reward is 66 points gain. So in this example, if you want to enter a long position at 1043, your key stop loss is at 1036, so it's a limited loss if your outlook is wrong, and the potential reward is very interesting with a 66 point gain. So that case, to enter right now at 1043 on October 9th, 2013, is interesting regarding money management and technical analysis. So we can enter a long position at 1043. What happened afterwards? On October 30, the index has reached our first target, which was set at 1088. Sorry. So it was the first target, was the first resistance, but the index has broken above this resistance and continued to accelerate on the upside. And now the index on October 30 is close to its second target I mentioned at 1130. But now on October 30, the index is reversing down, and it didn't reach the second target at 1130. So what we can do on October 30 in order to protect gains, you need to raise your stop. It's not stop loss, because if you raise the stops, you will be you will have a winner trade, but you need to raise your stop, and this stop should be a trailing stop. The idea is to cut losses short and let profit run. So as long as the index remains above key support, you don't have any reason to cut your long position. So you play the trend. You play the trend as long as the index remains above a key support. Now, in this example on October 30, the new stop loss, the new pivot point should be more aggressive than the previous one, because you have a positive long position. So the current price in this example is at 1105. And the new stop can be set at 1087, because 1087 on October 30 is an horizontal support and the rising 20-day moving average, which is in red in this example. So in order to protect your gain, you can raise the stop with a trailing stop, and you can raise the stop to 1087. In case of a more aggressive pullback on the index, and in order to protect your gains. What happened after October 13? November 17. November 70, the stop which was raised to 1087 has been reached. So your long position should be cut, and your gain, if you buy at 1043 in the example, your gain should be 44 points gain. So, but now the index has broken below the stop. It was set at 1087, and your gain is 44 points. The main goal is not to try to sell. I want to insist on that. The main goal is not to try to sell at the highest level, but to try to catch the trend as long as possible. So you have to keep in mind to cut losses short and let profit rise in order to play the trend, the maximum upward potential of the trend. But in that case, you are stopped out, but you are stopped out with a gain. November 8. What is the new scenario? What is the trading plan you can do? The index is still supported by a rising trend line drawn from the November 2012. So this is a first bullish argument. On the daily RSI, you have a rising trend line. So this is a second bullish argument. And we have also rising moving averages, the 20-day in red and the 50-day moving average in blue. So from a technical analysis point of view, the Russell 2000 is bullish, is still bullish, the outlook is still bullish. But at 1097, the question is, can I buy Russell 2000 at 1097, considering our key pivot point or key stop loss at 1063? The answer is no, because despite these key bullish arguments, the reward risk ratio is not good enough at current price, as if you calculate between 1097 and 1063, the risk is a 34-point loss, and the potential reward is a 50-point gain. So if you apply the reward risk ratio, the reward risk ratio is not interesting, and the potential loss is too important. So despite the fact you have a lot of bullish arguments, from a money management point of view, you can enter a long position. So this is important to keep this in mind. It's not sufficient to have a bullish configuration or bearish configuration from a technical analysis point of view. You have to keep in mind that money management is really important to survive in financial market, and it's better to let the trend playing without you instead of to take the risk of a larger loss. So to sum up, before to provide you a fresh analysis on 2 or 3 currency pairs, I want just a quick sum up to show you a quick sum up. So to sum up, the choice of a key pivot point, key stop loss is important. It must be a key technical level. Keep that in mind. So it's a sum up of my rules. So the choice of a key pivot point stop loss is important. The second rule should be the trend is your friend, and keep in mind that bottom fishing is risky. You need to have several bullish technical developments before buying, and you need to have several bearish technical developments before selling. The third rule should be that, and I think it's the most important, losses need to be limited if your outlook proves to be wrong. And keep in mind the reward risk ratio. It's very important. And of course, money management is essential for every traders, investors who want to survive in financial markets. So this is a quick presentation, but I wanted also to present you some analysis with live examples on currency pairs like euro dollar or Canadian dollar. So I'm going to share my screen with my technical analysis platform. Maybe could be interesting to have some question regarding forex currency pairs. I'm going to present maybe euro dollar, an example of euro dollar, Canadian dollar, but if some person have also another question on other currency pairs, maybe it could be interesting to ask me. So the first one I wanted to show you is the euro dollar. So for now, euro dollar, we have several, despite the current consolidation, we have still several bullish, several positive arguments. For example, the daily RSI is approaching a key support area which is set around 30. The daily MACD is approaching a tentative rising trend line, and we have also on the daily chart. This is a daily chart of the euro dollar. You have still the 50-day moving average, the 100-day moving average, the 200-day moving average, which are still rising. So we have still several bullish arguments to on euro-dollar despite the current consolidation. If you look at weekly charts, we have also an interesting configuration, technical configuration. As you can see, that the euro-dollar has broken above a key declining trend line, which was in place since 2011, in May 2011. We have also a key rising trend line on the weekly MACD and on the weekly RSI. So we have several bullish arguments, bullish developments on the daily chart and on the weekly chart. But now regarding money management, if you look at the euro-dollar, I think could be interesting if you have a look at Fibonacci retracements, that actually the euro-dollar is bouncing off the 50% Fibonacci retracement. So, and this 50% retracement is also the rising 20-week moving average that I show you on the weekly chart. So this 50% Fibonacci retracement at what 32.90 is a key pivot point, because it's the 50% Fibonacci retracement and the rising 20-week moving average. So if you want to enter a long position with all bullish arguments I mentioned, your stop loss should be at 132.90, because it's a key stop loss, it's a key pivot point, and first target could be the declining 20-day moving average, which is coming around 136.08 right now, and come back. You can expect a comeback to the previous high at 138.32. We have several bullish arguments, but we have also an interesting reward-risk ratio. So the timing seems to be interesting on euro-dollar right now, as we have a bullish configuration and a good and we respect our money management rules. So that's it for the euro-dollar. I think I saw an interesting configuration also on the Canadian dollar versus Japanese yen, which is very interesting, with a good reward-risk ratio. Actually, the Japanese yen is interesting against a lot of counterparts, but the CAD yen is on the weekly chart is very interesting, because on the weekly chart the pair is shaping a triangle. It's not validated yet, but it's shaping a triangle and should be, if we have the validation of this triangle, continuation pattern. And you can see that in late 2012, the pair has broken above a key declining trend line, turning the medium-term outlook bullish. But now we have a rising trend line on the daily chart. We are on the daily chart right now. Okay. And I think this rising trend line could be an interesting pivot point. So, to sum up, we have a rising trend line on the daily chart, and we are on the weekly chart right now, and we have the rising 50-week moving average, which is coming around the rising trend line we have on the daily chart. So I think we have two arguments to say that our rising trend line is a key pivot point, could be a key pivot point if you want to enter a long position on Canadian dollar against yen, Japanese yen. And I think the pivot point could be set around 93, and I think the first target could be I think there is an horizontal resistance around 97.50. And the second target could be around 101. So in this situation, we have an interesting pivot points, not too far from the last price, and we have interesting targets. So as for the euro dollar, I think the timing could be interesting on CAD yen to enter a long position with and we respect if you want to enter a long position, you respect money management rules. So this is also an interesting configuration for us. I saw something interesting on euro versus British pound. Not on a daily chart because it's unclear on a daily chart, but if you have a look on a monthly and a weekly chart, you can see that the technical configuration is becoming more and more interesting. So on a sorry, it's not a good chart. So if you have a look on monthly charts on the euro against British pound, we have several interesting patterns. The first interesting pattern is a reverse head and shoulders pattern. Okay, so the pattern is validated and has been validated in late 2007. So the big picture on the currency pair is bullish, but since 2009 we are in a consolidation mode after the strong bullish run seen between 2007 and 2009. So I think for several investors, several traders, the technical configuration seems to be not very clear. But if you have a look at monthly charts, you can see that we have more and more bullish arguments on a monthly chart and on a weekly chart. The first on a monthly chart is the 20 months moving average, which is turning up. It's the first time I think since 2010. After the last pullback. Actually, the last pullback, I think the last pullback is interesting to enter a long position. So we have an interesting reaction on the 20 months moving average, and you can see on the monthly chart that the pair is shaping a bullish flag. It's a large bullish flag, but on the monthly chart you can see this pattern like a bullish flag pattern. So should be a continuation pattern, and I think around 88 could be an interesting trigger for a bullish acceleration. But now, if we consider our money management rules on the weekly chart, sorry. So right now you can see that we have an interesting consolidation with an ABC consolidation, while the weekly MACD is approaching a support area around 0. And the most interesting thing is the 100-week moving average, which is acting as a support. And this 100-week moving average is turning up now. So we have several arguments to say that the low sorry, let me check. The low at 0.83 could be an interesting bottom and could be an interesting pivot point, an interesting stop loss. So considering 0.83 for your stop loss, with the first target around 0.87. Actually, 0.87 should be a key trigger for bullish acceleration. But now at that price at 0.84, sorry, the reward-risk ratio is interesting with a stop loss at 0.83 and a key first target at 0.87. In case of a break above 0.87, I think we could see a bullish acceleration to at least 0.9083. Okay, so we have a third interesting technical configuration on euro versus British pound, which respect all money management rules and which respect our technical analysis tools. So this is a third interesting example if you want to enter a long position on the Forex market. And I think we have time to see another chart on which one? US dollar against Canadian dollar. Yes, maybe it's not the best one. So another one on US dollar against Japanese yen. Sorry, it's a better configuration. Oops, sorry, I have okay, sorry. So on the weekly chart, on the US dollar against Japanese yen, we have the validation of a pennant pattern if you have a look at the weekly chart. So it is a continuation pattern, a bullish continuation pattern in that case. And if you have a look at the weekly chart, regarding technical analysis, you have a rising trend line on the weekly MACD and a rising trend line on the weekly RSI. So this is two arguments to say that the pair is in a bullish configuration, and the 20-week moving average is turning up after the validation of the pennant pattern. So from a technical analysis point of view, the currency pair is turning bullish again. And now, if you want to enter a long position, you have to determine a key pivot point. And I think the key pivot point could be set on the rising trend line we can see on the weekly chart, which corresponds actually to the rising 200 days moving average on a daily chart. So to build an interesting trading strategy on dollar against Japanese yen, the US dollar against Japanese yen, you can, regarding money management, you can enter a long position now with a key stop loss around 97.50 in order to target a first target, which was the previous high of May 2013, which was at 103.75, and should be the first target. And I think a second target could be, in case of an upside breakout of the previous high, the second target could be on the monthly chart, could be 105.60, which is actually 61.8 Fibonacci retracement of the entire decline started in 2007 to the bottom of 2011. So In that configuration, we have also interesting trading strategy with a good reward risk ratio and an interesting technical analysis. So I think that's it for me regarding examples and how to build a trading strategy. Maybe there are some questions from your side. Maybe we have time to focus on another pair, another currency pair. So I told you that I saw an interesting configuration on the US dollar against Canadian dollar. So we have just time to see that configuration. Yes, I saw that earlier today because today we had an interesting reaction, the reaction on the declining trend line drawn from the top of July 2013. So in that example, despite the current market consolidation on against this declining trend line, you can not enter a short position just with one argument, because the only argument I have on this example is this declining trend line, which is just a tentative declining trend line. We need a confirmation of this declining trend line, and if you have a look at other technical indicators like moving averages or daily MACD, you can see that these indicators are still bullish. So we have just one or two bearish arguments against several bullish arguments. So in that case, if you want to enter a short position, you can, but you have to put a very close stop loss. I mean a stop loss just above the declining trend line, which is coming around 105.15. But regarding technical analysis, you don't have sufficient argument to enter a short position. So in that example, you can see that you need to have a maximum of bullish or bearish arguments to enter a long position, but you can enter a position if you have a very close stop loss in order to respect money management rules. Okay, so that's it for presentation. I hope it was clear. A nice day, and I hope to see you soon. Thank you for your attention.